On March 26, 2021, a bank you'd never heard of received a phone call that should have crashed global markets. The call came from Goldman Sachs, then Morgan Stanley, then Credit Suisse, all within hours. The message was the same: you owe us money, a lot of it, and we need it now. The bank was Archegos Capital Management. The amount they couldn't pay? $20 billion. Within 48 hours, that number would balloon to over $30 billion in losses, scattered across some of the world's most prestigious financial institutions. Credit Suisse alone lost $5.5 billion. Nomura, nearly $3 billion. And here's what should terrify you. Most people never heard about it. Not because it was small, but because the system is designed to absorb these detonations quietly, shuffle the wreckage off camera, and keep the casino running. Let's back up. Bill Wang was a former hedge fund manager who'd been banned from trading in Hong Kong after pleading guilty to wire fraud. By 2021, he was running what's called a family office, a private wealth management firm that operates outside most regulatory oversight. Archegos wasn't technically a hedge fund, which meant Wang didn't have to report his positions to anyone. He used this invisibility to make a bet so leveraged, so concentrated, and so absurdly large that when it collapsed, it nearly took down half a dozen banks with it. Here's how it worked. Wang didn't buy stocks the normal way. He used something called total return swaps. These are derivative contracts where a bank holds the actual shares, but Wang gets all the economic exposure, the profits if it goes up, the losses if it goes down. The genius, from his perspective, was leverage. He could control $10 worth of stock for every $1 he put up, sometimes more. And because the banks held the shares, not him, his positions stayed hidden. No public disclosures, no 13F filings, just pure, undetected risk. Wang used this structure to build enormous positions in a handful of stocks: Viacom CBS, Discovery, Baidu, Tencent. At one point, Archegos controlled 9% of Viacom CBS. For context, that made him one of the largest shareholders in the company, and almost no one knew. Then Viacom CBS did what any company does when its stock price soars for no reason. They issued more shares. On March 22nd, the company announced a $3 billion stock offering. The stock dropped 15% in a day. For a normal investor, that's painful. For Wang, who was leveraged 10 to 1, it was a death sentence. His position started bleeding fast. The banks that had loaned him all that leverage suddenly realized they were holding billions in collateral that was evaporating by the hour. So they did what lenders do when the collateral falls. They issued a margin call. Pay us now, or we start selling. Wang couldn't pay. Here's where it gets interesting. When a margin call fails, the lender is supposed to liquidate the borrower's positions immediately, dump the shares, recover what you can, eat the loss if you have to. But Archegos had positions with multiple banks, and each bank faced the same dilemma. If we sell first, we might get out. If we wait, we're last in line when everyone else dumps. This is called a prisoner's dilemma with billions of dollars on the line. Goldman Sachs moved fast. They started unwinding Wang's positions on Friday, March 26th, quietly, aggressively. By Monday, they were mostly out. Goldman lost around $1 billion, painful but survivable. Morgan Stanley did the same. They took losses, but they moved quickly enough to limit the damage. Credit Suisse hesitated. They wanted to negotiate, to structure an orderly exit, to avoid flooding the market with shares and tanking the price further. It's the kind of polite, relationship-focused thinking that sounds prudent in a conference room. It cost them $5.5 billion. By the time Credit Suisse started selling, the market knew something was wrong. The stocks Archegos owned were in free fall. Every bank was dumping at once. There was no floor. Nomura made the same mistake. They lost nearly $3 billion. Now here's the part that should bother you. This entire collapse, $30 billion in losses, a shadow fund imploding, banks scrambling to avoid contagion barely made the news. CNBC covered it, the Financial Times wrote about it, but by April it was gone from the headlines. Markets recovered, the banks took their losses, fired a few executives, and moved on. No systemic freeze, no bailout, no congressional hearing that changed anything. Why? Because the losses were absorbed by the banks themselves. Shareholders took the hit, executives lost bonuses, but depositors didn't lose money. The system didn't seize. From the outside, everything looked fine. But zoom in, and you see something more troubling. This wasn't a rogue trader at a small firm. This was a concentrated risk so large that it cost multiple global banks billions, and no regulator saw it coming. Because Archegos was a family office, it didn't have to report. Because the trades were structured as swaps, the positions stayed hidden. Because each bank only saw its own exposure, no one realized how much total leverage Wang had piled on. The irony is that we built regulations specifically to prevent this. After 2008, the Dodd-Frank Act imposed stricter leverage limits and reporting requirements on hedge funds, but family offices were carved out. They manage private wealth, the thinking went. They're not systemic risks. Bill Wang had $50 billion in exposure, built on $5 billion in capital. That's not private wealth management. That's a systemic risk with a legal exemption. So why didn't markets stop? Because the system is built to contain these explosions just long enough for someone else to absorb the loss. Banks have capital buffers now. They can survive a $5 billion hit without collapsing. The cost gets passed to shareholders, spread across balance sheets, buried in quarterly earnings. It's contained, but it's not fixed. Because here's the uncomfortable question no one answered after Archegos. How many Bill Wangs are out there right now? How many family offices are running leveraged bets we can't see? How many banks are sitting on concentrated exposures they think are safe because the collateral hasn't moved yet? The only reason we know about Archegos is because the bet failed. We have no idea how many haven't.